Most people think currencies collapse because governments print too much money. They're wrong. The printing press gets blamed for everything: hyperinflation, monetary chaos, economic ruin. It's visible, it's measurable, it feels reckless, but printing is almost never the cause. It's the symptom. The real killer is invisible. It's the moment a government loses the ability to tax, because money isn't paper. It's a claim on future taxation. And when that claim becomes worthless, the currency follows. The pattern repeats across centuries. Spain in the 1500s, Weimar Germany in the 1920s, Argentina in 2001, Lebanon in 2019. Different continents, different eras, same structural break. The government couldn't extract revenue from its population, so it printed. And printing without taxation is not monetary policy. It's surrender. Understanding this changes everything. Because if collapse comes from tax failure, not printing, then watching central bank balance sheets is pointless. The real question is, can the state still command resources? Can it enforce collection? Can it maintain authority over its economic base? When the answer becomes no, currency death follows. Not because of ink, because of impotence. Let's trace the pattern. Start with Rome, not the fall of the empire. Earlier, when the Republic still stood, Rome's strength wasn't its legions, it was its tax system. Roman citizens paid taxes, provincials paid tributes. The state could extract revenue reliably across vast territories. That capacity funded roads, aqueducts, armies, infrastructure that reinforced control. If you're watching modern governments struggle with debt and wondering when collapse comes, stay with me. Because the mechanics that destroyed Rome are operating today, just faster, and the warning signs are already visible. Rome's system worked as long as extraction remained efficient, but efficiency eroded. Wealthy landowners consolidated power. They gained exemptions. Tax burdens shifted to smaller farmers. Those farmers, crushed by obligations, sold land to the wealthy, who then claimed more exemptions. The tax base shrank. Meanwhile, military costs grew. Borders expanded, threats multiplied. The state needed more revenue but could extract less. The spiral tightened. Unable to tax adequately, Rome debased its currency. The silver content of the denarius dropped from nearly pure to trace amounts. Soldiers noticed, merchants noticed, prices rose, not because of economic growth, because the state's claim on future resources had weakened. The currency reflected that weakness. Rome didn't collapse from debasement. It debased because it was collapsing. The printing press equivalent, coin clipping, was the last tool left. Fast forward to 16th century Spain. After conquering the Americas, Spanish galleons transported thousands of tons of silver from Potosi in modern Bolivia across the Atlantic into European markets. Prices surged. Historians call it the price revolution, inflation across the continent for over a century. The standard story blames silver abundance, too much money chasing too few goods, simple monetary theory. But Spain's crisis was structural. The crown relied on colonial extraction, not domestic taxation. Wealth flowed from mines worked by forced labor. But Spanish productivity remained weak. The tax base was narrow. The wealthy avoided obligations. The state borrowed heavily against future silver shipments, financing wars across Europe. When shipments slowed or got intercepted, revenue collapsed. The crown declared bankruptcy. 1557, 1575, 1596, multiple times. Silver didn't break Spain, fiscal architecture did. An economy dependent on external extraction without a resilient domestic tax base cannot sustain credibility. The empire had gold, but it couldn't tax its own people effectively, so it borrowed, then defaulted, then borrowed again. The cycle continued until Spain, once Europe's superpower, became a cautionary tale, not of printing, of extraction failure. Now jump to Weimar Germany, the textbook hyperinflation case. Everyone knows the images. Wheelbarrows of cash, banknotes used as wallpaper, prices doubling daily. The story told is simple. Germany printed recklessly. Hyperinflation resulted, disaster followed. But that story erases context, and context is everything. After World War I, Germany faced massive reparations under Versailles. Payments denominated in foreign currency, gold marks, not paper marks. The distinction matters. Germany could print marks, but it couldn't print gold. To pay reparations, it needed to export goods, earn foreign currency, then transfer it. But productive capacity was damaged. Political instability was constant. Then, France and Belgium occupied the Ruhr in 1923, Germany's industrial heartland, the source of coal, steel production. The government responded with passive resistance. It paid workers to strike rather than cooperate. A political decision, but economically catastrophic. Industrial output plummeted. Tax revenue evaporated. The state's ability to extract resources collapsed. Suddenly, Germany couldn't tax, couldn't produce, couldn't export, but still owed foreign currency. The fiscal gap exploded, so it printed, not as policy, as desperation. Hyperinflation followed, but the hyperinflation didn't cause the crisis. The loss of productive capacity and taxation authority caused hyperinflation. The printing press was visible. The structural fracture was decisive. Confidence eroded before prices spiraled. And once confidence breaks, printing accelerates collapse. It doesn't create it. The lesson is brutal. Currency credibility rests on the state's ability to tax tomorrow, not its ability to print today. A government that can tax can sustain debt. A government that can't tax cannot sustain anything. Printing becomes a race against collapse, and collapse always wins. Because you can't print taxation authority, you can only lose it. Argentina demonstrates this in slow motion. In 1991, Argentina pegged the peso to the dollar, 1-to-1, the convertibility plan, designed to restore stability after decades of inflation. For a time, it worked. Prices stabilized. Confidence returned. Capital flowed in. Growth accelerated. The peg held because people believed it would. Belief is half the battle. But pegs require discipline. The government must match spending to revenue. Argentina didn't. It accumulated debt, much of it in foreign currency. Dollars, not pesos. The economy grew slower than debt. Tax collection remained weak. Evasion was rampant. External shocks hit. Brazil devalued in 1999. Argentine exports became uncompetitive. Revenue struggled. But obligations remained. In dollars, investors began questioning sustainability. Can Argentina maintain the peg? Can it service dollar debt? The answer increasingly looked like no. Capital started fleeing. By 2001, the system cracked. The government defaulted on roughly 100 billion banks, restricted withdrawals. The Corralido, protests erupted. Presidents rotated rapidly. The peg collapsed. The peso devalued. Savings evaporated. The problem wasn't printing. Argentina hadn't printed excessively under the peg. The problem was the mismatch. Obligations in dollars, revenue in pesos, a narrow tax base, a government that couldn't extract enough to service external debt. Once confidence faded, the structure failed. Printing came after, as damage control, not as cause. Lebanon, in 2019, followed the same script. For decades, Lebanon maintained a currency peg to the dollar. Banks attracted deposits by offering high interest rates. The Ponzi ran on continuous inflows of external capital, expatriate remittances, Gulf investment, foreign deposits. The state borrowed heavily. Public debt exceeded 150% of GDP. But as long as dollars kept flowing in, the system held. Then the inflows stopped. Syria's war, regional instability, domestic mismanagement. Capital dried up. The state couldn't tax effectively. Corruption was endemic. The elite avoided obligations. The tax base was weak. When external funding disappeared, the gap became undeniable. The state couldn't pay. Banks froze accounts. The currency collapsed. 90% devaluation, savings destroyed. The middle class obliterated. Lebanon didn't print its way into crisis. It failed to tax its way out. The printing came after confidence broke, after the system revealed it had no real backing. Because backing isn't gold, it's taxation capacity. And Lebanon had none. The wealthy evaded. The state couldn't enforce. The system relied on external belief. When belief died, so did the currency. Across these cases, the pattern is identical. Rome, Spain, Weimar, Argentina, Lebanon. Each lost the ability to extract resources reliably. Each faced obligations it couldn't meet through taxation. Each turned to monetary expansion as a last resort. And each discovered that printing without extraction is not a solution. It's an announcement. The state has lost control. This is why focusing on central bank balance sheets misses the point. Japan's balance sheet is enormous. Debt exceeds 250% of GDP. The Bank of Japan owns vast quantities of government bonds. Yet the yen hasn't collapsed. Why? Because Japan can still tax. The population is cohesive. Institutions function. Debt is domestically held. The state retains authority over its economic base. The structure holds. The United States runs massive deficits. Prints trillions. Debt approaches 34 trillion. Yet the dollar remains the global reserve currency. Why? Because the U.S. tax base is broad and productive. It borrows in its own currency. Global trade is denominated in dollars. The state can extract resources. Institutions, while strained, still function. The structure holds, for now. Contrast that with Venezuela. Oil revenue collapsed. Production fell. The state depended on a single commodity. When prices dropped, so did extraction capacity. The government couldn't diversify the tax base, couldn't enforce collection on a productive economy, so it printed. Hyperinflation followed. Not because printing is inherently catastrophic, but because printing without extraction capacity is. The lesson is clear. Currency death is a political event disguised as an economic one. It happens when the state loses the ability to command resources, when taxation becomes impossible or ineffective, when productive capacity shrinks or escapes, when the population refuses to pay or the elite capture exemptions, when external obligations denominated in foreign currency exceed internal capacity. These are the fractures that kill currencies, not balance sheet expansion. If this changed how you see monetary collapse, share it. Because the next time someone says a currency will die from printing, ask a better question. Can the government still tax? Because if it can, the currency survives. If it can't, printing just speeds up the funeral. The corpse was already cold.